Welcome back to Next Gen Investing. It's time to discuss the latest delivery numbers from Rivian, which is seeing a pretty substantial move to the downside today on what was a clean beat across the board for its third quarter. So now I'd like to welcome in George Tsilis, senior markets correspondent for the network. So George, what is driving this weakness today? Same could be said for Tesla, but we're seeing it more notably, obviously, in Rivian. We did see deliveries that were able to at least please the consensus estimate, but that's not being reflected at all in share price today.
Yeah, there's a few things going on. I think, Rivian is moving in terms of down moves worse than Tesla. I think Tesla's moving down based on sort of a sell then use event with their delivery numbers coming in ahead of estimates. And that's to be expected because for those who don't follow this market, in the electric vehicle space, the federal tax credits for new vehicles, which is around $7,500, and $4,000 for used vehicles based on certain conditions, expired at the end of September. So that is a pretty large impetus that caused a lot of consumption or purchases moving into the last quarter, which is the end of the fiscal year for these companies. I think Tesla is moving in sympathy to the downside because of expectations of how they're going to make up for that. Then Rivian is also moving in tandem, I suggest, with Tesla. But there's a lot of other challenges with Rivian because, in the last year, the stock is higher, I think, around 28 or so percent, just roughly speaking. But I just look at the last 5 years, the stock was trading at $180 going back to, looks like late 2020, early 2021. It's down significantly. And the challenge for Rivian is that they can't produce enough vehicles. Just to give you some context, Tesla is just rounding up, producing about 500,000 cars a quarter. So that's roughly 2 million per annum. If you look at Rivian, they actually produced 10,720 cars and trucks, which SUVs and trucks. They delivered 13,000 units. So if you annualize that, it's effectively around 52,000 to 54,000 total. Which is a significant, share or significantly lower share than Tesla. Therefore, they can't achieve scalability, and that's a big challenge for Rivian, and it has been a challenge for Rivian for multiple years. They just can't seem to produce more than between 50 and 55,000 units, and therefore they're really stuck in terms of not being able to lower prices and effectively lower the cost of goods sold, which, if you look at it from a last 4 quarters standpoint, they generated in terms of sales $5.1 billion. So it's not sales isn't the problem. It's really the cost of goods, which is around $5.3 billion. So they have a negative gross margin, which you got to overcome that at the very least before you can start to get get closer to any sort of semblance of adjusted profits or even net income profits, for that matter. So therefore, my point is Rivian, albeit they seem to have very nice vehicles, SUVs and trucks, they seem to be popular, they just can't produce enough vehicles to get them over that scalable need threshold that Tesla has. And even after today's announcement for Tesla, the market seems to be selling a good news event, which may indicate some short-term topping action in companies like Tesla, which again is manifesting into sympathy plays like Rivian.
Yeah, George, you kind of highlight the irony of where if there is a little bit of a pullback in EV demand broadly, that actually could be net beneficial relatively for Tesla, who's already achieved scalability and profitability, where these companies that are trying to ride that demand wave to get there, if there's a fallback on that demand side, maybe they just don't get there. Is that the question that I think many are asking around Rivian right now?
Yeah, so, it's a tale of two companies, one that has achieved scalability and mass production and very efficient, but is also still trading at lofty valuations, but that's Tesla. So that is, different story in terms of what their technologies offer. But Rivian, I suggest looking at a couple of things. If you're looking at Rivian as an investment, just keep in mind that with $5.1 billion in sales, the company lost $3.5 billion last year. That's a significant net income loss. They do have around $7.5 billion in cash. So they have about $2 years worth, of cash available on the balance sheet. I do suggest that they're probably going to come in with secondary offerings to help shore up their balance sheet. Look for them giving guidance for production numbers. If you start to see 60, 70,000 unit production numbers, which may come about every quarter, when they reaffirm or reannounce some visible production units going forward, that's maybe when the stock starts to gain traction. So until then, just keep in mind that the losses are just going to overcome any gains the shares the company's making, and that's just my evaluation of what's happening with Rivian as a company.
Yeah, and I think a great also distinction between Rivian as a company and right now Tesla from like a profitability perspective. But appreciate that, George, for all that breakdown on Rivian today, lower on the session.